Every year around the time retirees turn 73, the same question pops up in my conversations. But Mark, I don't even need this money. Why am I being forced to take it out? And that's when I explain what's happening. See, that's the IRS knocking on your door, reminding you that your retirement savings in your traditional IRAs, your 401ks, were never really all yours. You got the tax break going in, they still want their piece coming out. So now you're required to start taking required minimum distributions, or what's called RMDs, whether you need the income or not. And if you think you're not going to take them, the penalty is a steep 25%, and that's on top of all the other taxes you're paying. So it stands to reason why most retirees see RMDs as a tax trap, something that drains their income faster, pushes them into higher tax brackets. But what if I told you there's a simple way to flip the script? Because with one strategy, you can actually turn those forced withdrawals into tax-smart income. Money that not only supports your lifestyle today, but strengthens your tax position for the future. Once you understand how this works, RMDs stop feeling like punishment and they start becoming a planning advantage. Hi, I'm Mark Wisniewski, President of Southern Incomes. If you find this helpful, go ahead and like this video and subscribe. And if you'd like to see how this strategy could apply to your own retirement plan, there's a link in the description where you can book a time with me. Now, let's talk about the one strategy that turns those forced RMD withdrawals into something that you actually want to take. Smart, strategic, tax-efficient income. The IRS doesn't care whether you need the money or not. Once you reach 73, you must start taking money out of your traditional retirement accounts every year. These withdrawals are called required minimum distributions, or RMDs. And while that might not sound so bad, here's the issue. Every dollar you take out adds to your taxable income. That can start the domino effect. You pay more tax on your Social Security, you can move into higher tax brackets, and your Medicare premiums, those IRMAA surcharges, they could jump by thousands each year. So it's no wonder why retirees dread RMD season. They feel forced to take income that they probably don't want, and they pay taxes that really they probably never planned for. But there's a smarter way to handle this. You can't stop RMDs, but you can redirect them, and that's where the strategy begins. Here's the first shift I want you to make. Stop thinking of RMDs as a penalty. Start thinking of them as an opportunity. The IRS is going to make you take that money, but they don't tell you what to do with it afterwards. That's where the strategy comes in, because the smartest retirees don't just take their RMDs and spend them. No, they use those dollars to improve their tax position, strengthen their overall income plan, or create a lasting legacy for their family. Once you make that mindset shift, the whole game changes. When your RMD hits your bank account, you've really got, I would say, 3 smart options. And the magic happens when you start combining them. 1, reinvest in a tax-efficient account. After your RMD is withdrawn, it's yours to use however you want. One smart move is to reinvest it in a tax-efficient brokerage account. So what does that mean? Well, you could use dividend ETFs, municipal bonds, or tax-managed funds to grow that money with less drag from taxes, while keeping it flexible and liquid if you need the money. You've already paid the taxes on it, so let that money keep working for you. 2, reallocate for income stability. So if you want more predictability, you can redirect your RMDs into safe income-generating vehicles like CDs, bond ladders, or annuity income riders. Remember that short-term income bucket? Well, wave your magic wand and you can replenish that bucket with your RMDs. That way, you're building a second income source that can support you in future years without having to tap into your account during market volatility. 3, reposition for legacy or for overall tax efficiency. And here's where it gets powerful. If you don't need RMDs to live on, you can use them to strengthen your family's financial future. Think about it. You could fund a life insurance strategy to replace the taxes your heirs would owe on your inherited IRAs, or use part of your RMD for Roth conversions, reducing future taxable RMDs and creating tax-free income later on in the process. Or if you're charitably inclined, make qualified charitable distributions, or QCDs. Get this, sending up to $100,000 per year directly to a charity of your choice, completely tax-free. So this QCD satisfies your RMD requirement and it keeps off of your tax return. It's one of the cleanest moves in the entire tax code. So here's an example. This is how one couple turned their taxes into what I'd consider an opportunity. So a couple I work with, they're both right around age 73, and they had about maybe 1.7 million in traditional IRAs, and their combined RMDs were right around $70,000 a year, even though they only needed about $40,000 to cover their living expenses. So instead of taking the money, paying the tax, letting it sit idle, here's what we did. $20,000 went directly to a charity that they selected through a qualified charitable distribution, that QCD. It was tax-free. The next $25,000 we used to purchase a cash value life insurance policy that created tax-free inheritance for their kids. And the rest we invested in a tax-efficient portfolio for long-term growth and flexibility that they could use if they needed some extra funds. Their taxable income dropped, their Medicare premiums stayed level, and they were able to support their favorite causes, all the while keeping their portfolio intact. That's the difference between an RMD reactively and one taken strategically. Reducing future RMDs. Here's something most retirees don't realize. Every year you strategically move money out of your IRA, you're also shrinking the size of your future RMDs. For example, let's say you're in your mid to late 60s and you're not yet subject to those RMDs. You can start doing partial Roth conversions. Each conversion removes a piece from your pre-tax balance and shifts it into a Roth, which has no required withdrawals. That means less taxable income later on, more control over all of your distributions, and a smoother tax picture throughout your retirement. Even if you're already taking RMDs, using part of them for Roth conversions can still help limit how large your future taxable withdrawals become. The beauty of this approach, it doesn't try to fight the tax law, it works with it. You can't avoid RMDs, but you can decide how those dollars are used, how they're taxed, and how they support your goals. And when you treat your RMDs as part of your larger plan, not just some kind of last-minute isolated event, they stop being a burden and they become a tool for smarter income, lower taxes, and a more intentional retirement. That's what I call turning required into rewarding. If you're approaching age 73 or already taking RMDs, this is the perfect window of opportunity. Don't pass it up. You don't have to accept higher taxes, rising Medicare premiums, or wasted distributions. With the right planning, you can fund your income needs, support your family or your favorite causes, and keep more control over what you pay in taxes. It all starts with being intentional. Building a plan for where every RMD dollar, you know where it goes before you ever take it. The bottom line, you can't stop RMDs, but you can outsmart them. With one coordinated strategy, you can turn required withdrawals into tax-smart income that works for you today, tomorrow, and also for your legacy. If you'd like to see exactly how this could work for your own plan, how to minimize your tax exposure, protect your income, and even use RMDs to build long-term wealth. Book a call with me using the link in the description. We'll go through your current accounts, your tax brackets, and your income goals, and I'll show you how to make every withdrawal serve a purpose to help you.